All right, well, we have one final session until we break for lunch. So welcome back. The next session may have a title of law, but don't let that scare you. Dan Cox serves as our quality assurance manager in our office. He's responsible for ensuring that our own audits meet the government audit standards, in addition to audits conducted by private firms. He oversees the quality of audits of the state agencies, the university systems, and all local governments across the state. With over 25 years of experience and his CPA license, he has worked extensively with both financial and performance auditing standards. Welcome, Dan.
For this presentation, I'm going to discuss three areas that we'll look at more in depth. We're going to look at the audit threshold changes, the recent law changes that happen. We're going to look at reviews versus extended reviews and what the differences are between them, as well as how to prepare for them. And then we're going to look at some of the common issues that we find during the reviews and understanding the various fund types that you use so that maybe we can help you not to have those issues that we find. And while this talk may primarily be geared towards smaller governments, there's also going to be some good information for the larger governments as well. These changes occurred in the 21 legislative session. And basically, there were two law changes that happened. The first was that all thresholds now are based on total receipts instead of some other number. And we'll get more into what receipts actually means in a future slide. But audit risk should be based on money, the dollars. And so that is why the threshold for what requires an audit should also be based on dollars. So in simple terms, the audit risk is the risk that the financial statements don't accurately reflect your financial position. And risk is made up of three components. There's the inherent risk, detection risk, and control risk. So to kind of put that in a different way, inherent risk are the external factors outside of the government that can affect the dollars that you work with. Detection risk is the risk that us as the auditor don't catch something that's been done incorrectly. And then control risk is the internal risk. Those are the risks that the controls you have in place don't catch what they're supposed to. But none of these, as you see, have anything to do with the population of a city or the student enrollment at a school. And that is why we implemented that change in the last session, because the previous audit thresholds were based on those numbers, and really it should be based on the dollars. The second change that was made at the same time was we increased the threshold. And we increased that from $300,000, which it was previously, to $750,000. And that might be a familiar number to some of you, because that is also the number at which a single audit is required. If you receive federal funding over $750,000, you are required to get a single audit. And so we match that same level. So who is primarily affected by this? Well, first of all, the cities, because they were previously under population. And so if you had a population of less than 500 people, you did not need to get an audit. And that has now changed, as I mentioned in the previous slide, to being on a dollar threshold of $750,000. It also affects school districts, which previously were under an audit threshold of less. If you had more than 100 students, then you need to get an audit. Now, again, that is based on a dollar threshold. And really, it affects everybody else as well, because the receipts level has changed from 300 to 750,000, as mentioned. Now, let's talk for a moment about receipts, because there's oftentimes some confusion on what exactly makes up receipts. So receipts is basically your cash received. So think of it as your normal operating revenue to begin with, your taxes, your fees, those types of things that you get on an ongoing basis. But it's more than that. It also includes a lot of one-time funding sources, such as grants or loans or bond issuances, sale of assets, donations. All of those things are also considered part of receipts. So really the bottom line is you can think of receipts as if you receive cash for it, it's a receipt. But even if you're not required to get an audit, there are still some circumstances, some exceptions in which you might choose to get one. So let's take a look at what some of those exceptions might be. First of all, the governing body may decide that they just want that extra accountability that comes with getting an audit, because the audit takes a deeper dive into the numbers, into the controls, and all the things that make up handling the money, the fiscal responsibility that goes with that. And so oftentimes governing bodies want that, especially school districts. Most school districts get an audit even before they were required to. Financial institutions may also require you to get an audit for a loan. And that is because they want to make sure that if you take out a loan, that you are in a fiscally responsible place to be able to pay the loan back. A bonding company, likewise, for the same reason, may also require an audit. And they, for the same thing, want to make sure that you're able to pay the bond back. And finally, a new auditor. A new auditor coming in wants to know that they're starting with a clean slate and they're not inheriting some hidden problems that occurred on someone else's watch. So we had a lag time to implement these law changes. As I mentioned earlier, it happened in the 21 session, but we are just now making them effective this year, 2022. So 2022 will be the first year that the financials are operating under the new threshold of requiring an audit above 750 or not needing one, just having to submit financial statements if you're below 750. So if you were on a fiscal year, which means your fiscal year ends June 30, or it could be any other fiscal year. We have a few districts that have year ends in March 31st or October 31st. But any fiscal year, that year ending this year, June in 2022, that is now under the new threshold. And if you're on a calendar year, then that deadline is coming up at the end of this year, December 31st of 2022. So these are the periods of time for which you'll have to get an audit, or you will now be able to do a financial review. There are several reasons that we requested these changes, these two changes that I just talked about. So first of all, monetary relief, especially for the smaller governments, because the reality is that audit costs are only going up. And there's a lot of factors that play into that. There's increasing number of audit standards, which require us to look into more information. There's increasing standards on what has to go into the financial statements. So it takes more time to prepare those and to test those elements that go into the financial statements. And as well, just the cost of people. Costs have gone up for employing the people that do the work to do this. So whether it's for our office, practitioners, CPA firms, those costs are going up, and we recognize that. That's why we wanted to try and provide some monetary relief by raising that threshold. It also provides some workload relief. Because there will be fewer audits that are required, there's not as many that need to be done, which is good because we're struggling to keep up with the client base that we have currently with the employees that we have. But it's even more so for the private firms that are even falling behind in getting a lot of their audits done, as you are probably aware of if you have a firm doing your audit. And same with the individual practitioners. It's gotten to the point to where many are not even taking new clients because they're already burdened down with the work that they've got because it's taking longer to get these audits done. So that's another reason. And that kind of leads into the third one, which is government auditor shortage. As we all know, there's a staffing pandemic that we've been going through, it makes it hard to find people, and it affects us like it affects everyone else as well. And additionally, on top of that, we also have fewer firms that are doing government audit work now than what there was in the past. And so there's plenty of audits to go around, but fewer to do them, which makes for a greater workload as well. So just as an example, statewide, including both public and private institutions, we graduate less than 200 accounting students per year. And only a percentage of those even stay in the state, many of which go into business. There's not very many left over for the firms and our office that are doing these audits to fight over. So that also leads to it. And finally, and probably one of the more important ones, is we have the ability to do extended reviews. Now, we've already done these, and I'll talk more about those in an upcoming slide, but we've had the ability to do these all along. It's been in our statute under 541014 subsection 3, the ability to do these extended reviews. It's just that previously we hadn't really implemented the procedures that are needed in order to conduct these reviews. And so these additional exams we'll take a look at on the next slide. So extended reviews can provide much of the accountability of an audit, but at a much more affordable cost. And that's important, especially since we're trying to provide relief to the local governments that are out there, to you. Because again, as we mentioned, we understand that the costs have gone up. So think of this as kind of in between a review and an audit. And it's a deeper dive into the records, but with a narrower focus, scope of what we look at. And that's based on what we have determined as particular areas of risk. So what are some of those areas of risk that may trigger an extended review? Well, first of all, there are those entities those local governments that previously were under the old threshold of 500 population or 100 student count, but yet they had revenues well in excess of the 300,000 that everyone else was having to get an audit on. So those local governments would be considered an area of risk and thus would get an extended review. Another group will be the ones that just take effect this year, and that'll be the ones that have less than 750, and so they no longer are getting an audit. Maybe they have in the past because they were over 300, but they're under 750,000 in total receipts. They'll no longer be required to get an audit, but yet they still need that extra scrutiny, at least for a time, and so they also would be ones that would get an extended review. Other things that we see during the review process can also extend in an extended review, and that can be such as if we see evidence that you don't understand the fund types and the use of them when they aren't supposed to be used. And we'll go in more in depth in that in a future slide so that everyone can better understand when we do use these funds and what they're for. It can also be if we see evidence that you don't understand transfers and when transfers are supposed to be used and for the proper amount. Again, we'll look into that further in a future slide as well. If we see negative fund balances, that will often trigger an extended review. And the last two would be if there are large construction projects, if we see those, because that can bring in some bidding concerns on whether bidding requirements were followed. And so we may do an extended review for that purpose. And then the final one is if we have a large miscellaneous or unclassified expense category and we can't tell what's there, it just provides a lack of transparency that really causes us to want to take a deeper look into that. Other thing with extended reviews is that once we have done one, if there were no issues, then after that we would just go back to the regular review process. So it's not like once you get an extended review, you would continue to have those. So preparing for a review or an audit for that matter, because this will all work for in that area as well. The thing is that we're looking for assurance. And it's assurance that you did what you were supposed to do, or you didn't do what you weren't supposed to do. So we get this assurance by looking at the evidence, what you actually did. And that comes in the form of the documentation or the records. So the initial review that we do, which is that first tier that most small governments get initially, is basically we're looking at your bank statements. And we are making sure that you are starting with the right beginning balance, that you end up with the right ending balance, as well as that numbers are in the right place and everything is accounted for as it should be. That's our standard review process that we do. If in doing that process, though, we see things that look unusual or we have questions about, then we'll elevate it to that second tier level. And that's where because of those questions, we'll contact you and we'll send you an email. We may call you and just to get some explanation. It may require you to send some additional information to us. Maybe a receipt or a contract, maybe it's just a check register or some financial statements from your accounting software, just enough to answer the question and on whatever it was that came to our attention. If, however, as I mentioned with those earlier risk factors, if those are in play, because we've seen that the financial statements that were submitted have a lot of issues or things that raise concern, then we'll elevate it to that third tier, which is our extended review. And in there, we'll ask for a lot more documents based on wherever those areas of risk fall. And that could be with invoices, your budget, meeting minutes, contracts, whatever it is that will lend credence to what it is that you did or give support for what it is that you paid for or received. And those can be, we can look at specific areas that relate to the expenses. It could be looking at the revenues. Could be looking at payroll, it could be looking at your bidding procedures if you did big construction type projects, whatever the particular area it is. It wouldn't necessarily be all of them. Again, as I mentioned, these have a narrower scope, so we can just pinpoint the specific areas we want to delve into and then just look at those in particular. It's important that you know then where these documents are. And especially with the bank statements and all the way up through the other things that I mentioned, know where your records are. Because when we ask for the information, the more quickly you can provide that, the more quickly we can do the review. And the reason that helps is because we bill just like an audit does based on the amount of time that it takes to do the review. So the quicker we get the information and can get through the review, the less time we are spending on the review, the less that you are billed for that review. And the same principle works with audits as well. And the thing is too, is that with those records is to make sure that you clarify on there for the questions that we ask, make sure that you keep just good documentation for everything that you do. So our goal in doing the reviews, our goal is to help you with your reporting because we recognize that you may not have an accounting degree. And we want it to be clear that you don't hesitate to call us if you have questions, and not just after you've submitted something or wait for us to call you with questions. Call ahead of time with questions if you're not sure how to do something. The reviewers that I have that work on this are ready and willing to help you answer your questions. And that way, maybe we can avoid these issues that I'm going to be talking about in just a moment that we commonly find. So and make sure you understand as well any changes that were made with the previous review that was done. So when we finish the review and submit it back to you, we give you, if we made any changes, and because we found things that need to be fixed, adjusted, moved, whatever the instance is, we'll give you a copy of that along with the bill, but that way you can see what we did to fix your records to get them to where they should be. And so make sure when you get those that you thoroughly understand why that happened, because that will also help you to prevent you from making that same mistake the next time. And it will also help to make sure that you are starting off with the right numbers for the subsequent year. So First, before I get into the issues though, I'll mention that we have a new form coming out January of 23. So the beginning of this next calendar year, we're going to have a new form to fill out for these small government reviews. We are working right now on developing that, and it kind of has a twofold purpose. First, for us, we really want to get more information, more data, basically to provide more transparency. You know, we feel that the citizens that you serve, that you are a steward of the money for, need and want that transparency. And so we don't have all the information that we need now based on the current form. So we will be asking for some additional information for that purpose, because it's important to the public that they know such information such as your assets or your total debt that you currently have. Which we don't currently ask for. But at the same time, for you, we're going to make this form so that it's easier to complete. Because I know, especially for small cities, with all the various tabs and everything in that spreadsheet, that it can be a little daunting, especially if, like I mentioned, you don't have a strong accounting background. There's a lot to know and to do and to get right, which means there's a lot of opportunities to mess it up. So we want to try and streamline that form, that while we're still asking for more information, that the overall process is an easier, smoother process for you. And so not just to understand what you're doing, but make it easier to complete the form as well. So that's our goal with that form. So there's something for you, something for us. So you can look forward to that coming in 2023. Beyond that, though, as far as the issues we find, I wanted to kind of go over what some of the common issues are, because maybe by bringing them to your attention, it will help you to be aware of these things so that you're not as likely to make those mistakes in the future. So first off, the year-end bank statements. Whether you are at a fiscal year-end or a calendar year-end, make sure that when you submit the financial statements to us, that you are including that year-end bank statement, that June 30 bank statement, or that December 31st bank statement. Because really, that contains the ending answer. That's the right answer is on that form. These are cash basis statements. So whatever is in the bank at June 30 or December 31st is the right answer. That's the answer we're looking for. And so we need that to know what that is. And again, as I mentioned in the previous slide, anytime we have to spend the time to request information that should have been submitted up front, that takes time. And time not only to make the request and then receive it in and get it and look at it at that point in time, but while we're waiting for that, we've moved on to other projects, then we have to come back, then you have to get back into the right mindset of what we were looking at and why. Again, that just adds to the time. And as we mentioned, time is money. And so this will help you. Again, these are all things, any of these things, of these common issues. If we do not have these issues, the review goes much quicker, which means you have a lower audit bill. So any of these issues that you can fix ahead of time lowers your chance of having a higher bill. And again, a lot of this stuff is applicable for if you're receiving an audit as well. So make sure you submit those year-end bank statements at the time that you complete the financial statements and submit them to our office. And that actually reminds me, one other thing I just thought of with that new form, just so you understand, when that form does come, that's just kind of a precursor. Eventually down the road, we are planning to have that form to where it can be completed online and submitted directly to our office that way. That will give you the ability to just do it online, and we'll have built-in edit checks with it, which will help to make sure that common mistakes aren't made with the numbers. And so we're going that direction. We're baby stepping it there. The first thing we'll do will be to revamp the form, as I mentioned. So, but back to the bank statements, it's not just the year-end bank statements that we need, which we do, but it's all the bank statements. That's another common issue that we find, is that we don't get all the bank statements that we need. And usually everybody, if they send them, they always obviously remember the checking account and the savings, which are typically together. But a lot of entities, a lot of districts, local governments, you may have an investment. And that investment could be a money market, a CD, whatever. Oftentimes, those investments are held at a different bank than your regular accounts. So you also need to remember to send those bank statements as well, because again, that's all part of the equation of what your ending cash balance is. Because in a cash balance statement, these short-term investments, which is what money markets and CDs are considered, they're short-term investments because they can be converted into cash at any time. Even if you have to pay a penalty, they're still convertible to cash. Therefore, on a cash basis, which is what these are, they are considered as cash. So that's part of when we talk about what your ending cash balance is, it's not just what's in your checking account, it includes any of these short-term investments as well. That's why we need those bank statements. So that's why you need to remember, if you have those, to send those statements in as well. So from there, that kind of segues into the interest earnings. Most often your checking and savings accounts probably aren't going to be accumulating any interest. But your short-term investments accounts will. And the forms currently require that you report those earnings separately as a separate line item of revenue. So make sure that you are looking at those, especially if they're in a different bank account. It'll have in there interest earned or dividend earned or whatever, it's the same thing. Make sure that you find that number and report it as a revenue, which it is, because it's another source of money that you received, a receipt, if you will. And that also adds into what your ending cash balance is. So make sure you look at those different bank account investments and include that interest earnings as well. And then the last thing on this particular slide is using the online form. And hopefully in the future, when we come out with a new form, this will be an even easier process than it is now. But make sure you're using that online form. I know several of you may have printed it off and you just kind of got it in a file cabinet. The best way to make sure that you're using the most current form is to use the one that's on our website. And so I would encourage you to make sure that you go out to our website each time and use it. And rather than just printing it off and just writing it in by hand, because then we have to try to decipher handwriting, which can also slow down the review process. Besides all that, the online form has formulas built into it. And so if you use those formulas, it actually makes it quicker to fill out, and it's more accurate because the formulas will do a lot of the work for you. So you don't have to worry about making some of those simple mathematical errors when you're adding stuff up or subtracting numbers or whatever. So make sure that you do that, because once it's completed, once you've filled it out online, if you want to print it to a PDF to send it in by email, that's fine. But it works best, and you can save yourself a lot of hassle if you do the online form first. So some additional issues that we have to do with the beginning balance amounts. So the beginning balance amounts, it's important that you start with the right numbers, because the reality is, if you don't start with the right numbers, you're certainly not going to end with the right number. So beware especially of prior year statements. If we made changes to your ending numbers, make sure you incorporate that into your new beginning balance numbers for the subsequent year. Don't just go off of what you had in the books, because oftentimes what will happen is you're completing these because you're working off of some software accounting program that you got, QuickBooks or something like that. And so you'll have your ending balance for the year, and you submit us the report, we go through the report, we find an error, or we have to make an adjustment, or we have to move something to a different fund. And then we send a copy of that, what we did, our changes that we made, we send that back to you, and you look at that and understand what's happening with that. But then those changes don't get put into your accounting software. So then when you go to do the next year's report and you print it off, it's starting with the wrong number because it's starting with what was in the system from before that never got edited for the changes that we made to your report. So you need to make sure that whether it's manually or you put it into your system, that you're making those adjustments hopefully in the system, so that when it prints off your new reports that you work off of, that you are starting with the right beginning balance number. So make sure you take note of that if we make any changes to your ending balance numbers, that you make those changes as well. So the next year you're starting with the right number. The next thing we see is overriding formulas. So as I mentioned earlier, the formulas are there to help you and to do the math or to transfer the number from one page to another page to put it where it belongs. It's all about making the process easier for you and cutting down on the possibility of errors or mistakes that can be made. However, if you overwrite the formulas, that doesn't work so well. So be careful not to do that. And I understand why it happens, because even if you're not an accountant, if you're the one filling these out, you want the numbers to balance. You can tell what two numbers should tie out to each other. You know, what you have on the books versus what's in the bank, you know, those numbers should equal. And you know that inherently, but yet when you plug in all your revenues and expenses and everything else, and it doesn't work, you just want to make it work. I get that. But if you overwrite a formula and plug in a number to make it work, to make it look like it balances, that doesn't help you. And the reason is because our reviewers will find that out very quickly, and then they have to go back through all the numbers to find out, okay, which number is off in order to create this issue. And so it just takes more time. What we would rather you do is if you put in all the information you have, all the revenues, all the expenses, and in your mind, everything's accounted for, yet it doesn't balance, yes, you can go back and try to go through your books and figure out where it's at and spend the time and whatever. You can do that, and that's fine. But it may actually be less time and less money if you just send it to us. Even if it doesn't balance, send it to us. Let us find what's wrong and fix it. Yes, I understand that will add a little time to the review, but it will take our reviewers probably a lot less time to find that than it would take you to find it. And so you have to ask yourself too, what's your time worth? So that's something to keep in mind when you're doing those. And we don't mind. We'll if it doesn't balance, we'll find it, we'll fix it. So investments. So with investments, I mentioned this earlier, but these are cash basis statements, which means investments, these short-term investments, CDs, money markets in particular, and that's what most, if you have one, that's probably what you have. But these are like cash. So when you cash one in, it is not a transfer. And we often see that problem where on there'll be, like, say you have a separate fund from your general fund. You know, everybody has a general fund, but say you have another fund, some special revenue fund, for example. And in that special revenue fund, you have money that's sitting there for a while. So you put it in a money market or a CD so you can earn a little bit of interest. That's a good thing to do. And then the time comes when you're going to do that project and you are cashing in that CD or whatever. So then you cash it in, and people, now all of a sudden they've got all this extra cash that they moved over to their general fund, and they think they need to put a transfer in. That's not a transfer. When you cash in a CD, and it's not a revenue either, we often see that if you keep it in the same fund. It's not a revenue, it's not a transfer, it's just cash. There really is no effect. Nothing goes on the financial statements when you cash in a money market or a CD. So keep that in mind. Sometimes we kind of overthink those of what we need to do to show that, and really you don't need to show anything because we tie out to all the bank balances, which is why we need to make sure we get all of those bank balances. So that's with investments. Next one is unallowable payments. This is something you need to be aware of. It's a newer area that we've been delving into more recently, and I'm sure some of you have heard about these, but there are actually three main unallowable payments that we are coming across. First of all, and just so you're aware, if there's, and I mentioned earlier about the importance of keeping the documentation or the records, the evidence of what you did. If there's no documentation, if we ask for an invoice and you can't find it, you can't produce it, that becomes an unallowable expense because we have no way of verifying what that was actually for. And we have to be able to see the evidence. You know, it can be recorded in a certain way. You can tell us that it was for this, you know, related expenditure that is okay to do for your entity. But if we can't see the proof of that, we can't make that same judgment. Therefore, it becomes an unallowable expense. So make sure you keep the records because without them, they just become an unallowable expense and we have to report it as such. Another unallowable expense that we've come across recently are payments for personal benefit. And this can be things such as food or alcohol or gifts. And these are not allowable by the North Dakota state constitution. And so I'll actually even read you the section out of there. It's just a brief section and it's found in Article 10, Section 18. And a part of that section says that neither the state nor any political subdivision thereof, which would include all of you, shall make donations to or in aid of any individual, except, and there is an exception, except for reasonable support of the poor. So anything else though, any other kind of payment is a form of support. So you cannot make, as a government entity, you cannot make those types of payments to individuals for items such as food or alcohol or gifts, because that's just a personal benefit and that's in violation of the Constitution. So just want to make you aware of that up front so that everyone is on the same page with that. Another one that we come across recently is compensation to volunteers. And I understand the heart behind that. I get that. But remember, these people are volunteers. They did it not expecting to be compensated. So it's best to leave it that way because it can also get you into trouble specifically with the IRS. Because if you give them something or do something for them or pay them something as a volunteer, that then becomes reportable on a W-2, just as if they were an employee. And if you are not doing that, you're in violation of IRS code. And you don't want to go down that path either. So those are some unallowable payments that I just wanted to make sure to get out there ahead of time. We're not looking to try and find these things from a gotcha perspective. We just want you to be aware of what you need to do because we know that you want to do the right thing. And so we're trying to help you in that area. That's why we're bringing these up. And then the last one I was going to go over, and I'll just touch on this briefly because Alex went over this pretty extensively in the previous session, and that has to do with the budgets. And the thing with the budgets and really the areas that we see most particularly have to do with ending cash balance for one. You know, part of that budget process is you have to know how much money are we starting the budget year with. Okay, and that amount of money that you start the budget year with is dependent on how much money you ended the previous year with. And so that's one of the things you have to do is estimate that ending cash balance. One of the things we've been seeing lately as we've looked into some of these budgets during our extended reviews is we see that expected ending balance to be zero. That's just not realistic. No local government, you are not going to end your year with no money in the bank. Nobody operates on that thin of a line. So that's a thing you have to be aware of is that it needs to be a realistic number of what you think will be in the bank once you've accounted for all of the revenues that are yet to come and the expenditures that are yet to be paid. And typically most local governments get the bulk of their expenditures or the bulk of their revenues up front in the first few months of the year, because that's how property taxes work, and that's where a lot of this comes from. So that's usually pretty easy to estimate, and expenses can just be estimated based on whatever you budgeted that you think will be. You can just go based on the budget. So that makes it a fairly easy calculation to come up with. You just take the difference between those two, add it to your current bank balance, and that becomes your ending bank balance. So keep that in mind. Another mistake that we often see is when you're thinking about, well, what additional revenues do I have for the year? Remember that you are allowed, and this is something that actually works in your favor, you are allowed to have a 5% unallowable expense, uncollectible for that revenue, because the reality is you're not going to get all the property taxes that you owed. It just doesn't happen. So that's something to keep in mind. And then the last one is transfers to the capital project fund. You are allowed to do transfers to the capital project fund. And we'll talk about the capital project fund in a moment, but the reason this happens, or you want to do this actually, is because you may have to levy extra taxes for multiple years before you have enough money saved up to do the project. So if it sits in your general fund, then that's part of your ending cash balance. And so that restricts you from being able to get more property taxes that you may need. Move that money to a capital projects fund. And again, I'm sure Alex touched on that in the previous session, but I just wanted to emphasize that this is something that we often see that gets messed up. So let's talk about the fund types. So the general fund is the most common. This one it covers all operating activity. Everybody has a general fund. You're actually required to have a general fund. And what we'll do is, as we step through these funds, I'll explain a little about the fund and why they're used and when they're used, as well as what types of transfers you can do in and out of these funds. So the general fund, it's used for anything. It can pay anything. It's general. And likewise, the transfers, you can transfer anything into the general fund, and the general fund can transfer out to any other fund. So it's wide open. And so that's the easiest one to understand. So let's move on to special revenue. Special revenue fund is when you have a dedicated source of revenue that's restricted or committed for a particular purpose. So let's back up just a moment, just to make sure you're catching this. So restricted means that it's by whoever it is that you're getting the money from. So the most common example, especially for cities, would be the highway fund. You get tax revenue for the highway fund. That's restricted in state law to be in a separate fund because it can only be used for a particular purpose. So that's restricted funds. Committed funds are done by the governing board. The governing board or council or whatever it is, whatever the governing body is, they can commit to doing a particular project and can commit some of your general fund revenues for a particular purpose. Okay, so that's how that revenue is created for a special revenue fund. So if that happens, that's when you should use a special revenue fund. Anytime it's restricted by whoever it is you're getting the money from or committed by yourself, it should end up in a special revenue fund. And it's for a particular purpose. So if you don't have a dedicated source of revenue, if you don't have one of those two, you just want to do something, just leave that in the general fund, put it as a separate line item. You can track it that way. Save the special revenue fund for those revenue sources that are restricted or committed. And it's for a particular purpose. That means you cannot transfer out of the special revenue fund to another fund until the purpose is fulfilled. So once the purpose is fulfilled, special revenue funds are meant to be short term. They don't last forever like the general fund. Once that purpose, whatever that purpose is, has been completed or fulfilled and the project's done, whatever that is, whatever is remaining, you transfer back to the general fund. And that's the only place it transfers. That's the only time it transfers. So let's go then to enterprise funds. These primarily deal with the cities. Of course, you think the common ones, your water, sewer, garbage, everybody understands that. But one of the questions that often comes up is, when do I do a water versus a sewer versus garbage? Can I combine them? And really that comes down to, how are you getting the revenue for them? So normally this goes out in like a water bill is most common. But if on that water bill, it itemizes, this is how much is for water, this is how much is for sewer, and this is how much is for garbage, then you have to have a separate fund for each one of those. If instead it's just one amount saying this covers it all, and it's just a one amount that's not itemized, you don't track the expenses separately or anything like that, then you can just have one fund in the enterprise fund that says water, sewer, and garbage, or whatever it is made up of. So that's kind of the cue for how you know whether it should be that way or not. Now, transfers, you can do transfers out of the enterprise fund, but there's limited. Century Code in 403312 limits you to only being able to transfer 20%, up to 20% of that year's revenue out of the enterprise fund. Where does that transfer go? Anywhere you want. You can put it into any other fund from the enterprise fund. That's fine. It's extra. It's considered as general fund monies at that point, but you are limited. So that's something to keep in mind. The capital projects fund and the debt service fund are used. So the capital projects fund is basically, they're used for projects, construction projects. If you want to store up money to either make a large capital purchase or to do a large construction project. So that's when the capital projects fund should be used. Likewise, the debt service fund is used in conjunction with it. Once the project is done, the debt service fund is used to track the money to make sure that you can pay it back. If you took out a loan or a bond to do that project. If the whole project is funded just from extra property tax revenue from the general fund that you transferred in, then you don't need a debt service fund because there's no debt. So it's only used for those times when you need to take out a loan or a bond or something of that nature. And then the last one, trust custodial fund. Think of a custodial fund. It's basically, it's not your money. And you are getting it, but you are only getting it primarily to pass on to somebody else. Because again, it's not your money. This often happens with small cities, or any city for that matter. If they get money for like parks and airports, they'll receive a part that they have to pass on to them. That's an example of custodial monies. It should be recorded in a custodial fund, because that fund balance will always be zero, because the money comes in and the money goes right back out to whoever it's meant for. So transfers? No, not really. The only transfer is you're giving the money to whoever it belongs. So there's not really transfers that are done out of that fund. So then for my final slide, I'm going to just take a little quicker look at capital projects funds and debt service fund, because these are the two that are the most difficult to understand. And these are used in government accounting to track financial resources used to acquire or construct a major capital asset. So that's when you use a capital project fund. When you know that you're going to acquire or construct a major capital asset. So anytime you do that, you should set up a capital project fund. And the reason is because when you have a substantial investment, it needs to be recorded correctly, because you're trying to decrease the chance of fraud or embezzlement happening. And so that's why these are required by GASB standards. So let's take a quick look at the capital projects funds. And again, I know that I have a lot of journal entries here, but really that's the kind of stuff that happens in your accounting software. Really what I'm trying to do here is just illustrate how that would work in just a simple example. So if we quick walk through these entries, you can see the first one there. Basically debiting cash, crediting your other financing sources and uses. Basically that means this is what would happen if you were going to transfer, say, $100,000 from your general fund into a capital project fund. So this is what that would look like in the capital project fund. Now, conversely, on the flip side, in the general fund, you would have recorded the exact opposite entry. But basically, you're just putting money in there, seed money, if you will. Now, if you decide to take out a loan or a bond, for example, that would show up in the next entry. Say we took out a $200,000 bond, ignoring the fact that there's premiums and discounts and interest and financing expenses and all that sort of thing. Let's just assume you got $200,000 for your bond. Again, you're putting it in that fund. It's cash, it's sitting there. And then the credits are their financing source and uses. So what happens then? Now you've got 300,000 sitting in there. So in the first year, if you had 180,000 of expenses, but say the project's not done, it's a multi-year project. Then you go into year 2 and you have an additional $100,000 of expenses. Now the project's complete. Well, what happens? Well, we had $300,000 in there. We ended up with $280,000 of expenses. We have $20,000 left over. So what do we do with that $20,000? We transfer it out. So the transfer from the capital projects fund only goes one way. It goes into the debt service fund if there's debt. As I mentioned earlier, if there is no loan or bond and it's just all money from the general fund, then that transfer would just move right back to the general fund. But in this case, it goes into the debt service fund, and that becomes seed money then in the debt service fund for paying back that debt. So the debt service fund, as I mentioned earlier, this is basically a cash reserve, and this is maintained to make sure that you can pay your obligations timely. This decreases the risk that you won't be able to pay for whatever it is you got, the loan or the bond or whatever. And this is used to track the resources. It can be used to track resources. Sometimes it's legally required by whoever you're getting the money from. GASB itself requires you have a debt service fund if the project is being funded by property tax dollars. So again, just quickly stepping through the entries, then that 20,000, you can see there's the cash. We're putting the cash in that we got from the capital project fund. So now in order to pay for this, we're going to have, say, an annual tax that we have on our citizens in order to generate this money to make our bond payment. So we estimate our bond payment's going to be $30,000 a year. So what do? We have property tax revenue of $30,000, and that money goes into this fund. That way, as you can see on the third entry, when we have an expense and we have to make that bond payment, the money's there. So then we make the bond payment. And that entry keeps happening year after year after year until it's paid off. When all is said and done, if you have money left over, in this case, let's say when all is said and done, we ended up with $10,000 left in there, then at that point, you close out the fund and that money moves back over into the general fund. And so, because again, remember, these are both temporary accounts. So that's how you account for those. And that's why these are important, is because, again, we're talking about a large investment, and we want to make sure that we have that accountability there to make sure that we can pay back that debt that we've taken out. That's what the citizens are concerned about. And so that's all I have for this session, and I thank you for your time.
And thanks everyone for joining us for our morning sessions. We did receive a number of really wonderful questions in the chat window. Because we are presently out of time of our morning session, we are going to answer those at our 2:30 question and answer session. So be sure to tune back in at 2:30 and we'll be covering all of those that were put into the chat window. Feel free to post any chat questions that you have in the box and we will get to them. We're now going to take that 40-minute break for lunch. So we will see you back here at 12:30 for our session on single audit. Thanks so much and have a good lunch.